We are watching the slow motion crash of what used to be an unstoppable force. This is a real-time lesson in why an investor must understand what the core value proposition of a business is. And by understanding that, an investor can quickly realize when that business has turned away from its core. Because when a business no longer serves its value proposition, value destruction is not far behind. And that is what we are witnessing with the once beloved Starbucks. Welcome to the Quality Investor. The third place, a place between work and home where patrons could come and relax, socialize with friends, or even work a bit, all while sipping delicious coffee. That is what allowed Starbucks to grow from local Seattle coffee house to an international powerhouse. A Starbucks opening in a new location was an event. It lent an urban sophistication to small towns. It felt exclusive. That was in the late 90s, when the coffee chain only had a couple thousand stores. Today, we have an oversaturated market. Each store feels hard, cold, and uninviting, as opposed to the warm ambiance and comfort-focused interior back when Starbucks could truly call itself a cafe. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Now, it is drive-through and mobile orders, long wait times as understaffed baristas prepare a myriad of concoctions for impatient customers. But you don't have to take my word for it. All of these qualitative markers, or rather lack of quality markers, have manifested where it matters most to the quality investor: the bottom line. The downward spiral continues for Starbucks as they released their Q2 2025 earnings. This is a business in decline, a business that seemed unstoppable a decade ago, one of those businesses that would make top 10 buy and hold forever stock lists. Starbucks was the third place. That's what separated it from its competitors. It had a simpler menu, and the quality was seemingly superior. But Starbucks made a critical error. Well, errors, but the primary error was its shift away from the third place to just another place. Drive-through and mobile ordering. Starbucks was basically fast food. They tried to justify it with COVID or adapting to the on-the-go customer, but it doesn't matter. Their economic moat has been breached, and what took decades to build has been destroyed in a few short years. I'm going to look at Starbucks earnings in this video and discuss if the new CEO, Brian Niccol, is breathing new life into this dying brand. He has an ambitious strategy termed Back to Starbucks that is supposed to recapture the essence of the third place. Is this earnings report showing signs of turnaround? Or is Starbucks just another oversaturated restaurant with high prices and mediocre beverages? And is this business even worth what the market is asking? So, grab a cup of delicious coffee and join me as we review the earnings. Yesterday, before earnings released, Starbucks closed at $84.85. However, after earnings released, things did not go so well. You can see the large post-market decline here in share price, and pre-market, they're down about 10%. It's not going to be a good day for Starbucks, but with good reason. Right away, things in the earnings release don't look too rosy for Starbucks. You see, global comparable store sales declined 1%. But what's worse is it's driven by a 2% decline in comparable transactions, and then offset by this 1% increase in average ticket. In the US, it's even worse. US comparable store sales declined 2%, driven by a 4% decline in comparable transactions. Yet, we had that offset of a 3% increase in the average ticket. So what does that mean? That means fewer people are actually doing business with Starbucks. They were only helped by the fact that their price increases raised the average ticket price for every one of those transactions they did do. But it signals something else. I think it signals that Starbucks has reached the very top of their pricing power. Once you start declining in transactions, that means there's a lower demand for your product. And the lower demand, I think, is driven primarily by these massive price increases we've seen from Starbucks over the last few years. Charted Starbucks price inflation from 2014 to 2024. These price increases are pretty staggering, and they've certainly increased faster than the overall US inflation rate. Part of that is Starbucks had pricing power, but I do think we're getting to the top of that pricing power. Tall mocha frappuccino at 32% increase over the last 10 years, 30% increase in venti chai tea, a 44% increase in their breakfast sandwiches. This is starting to hit customers' wallets pretty hard, and they're responding by going to Starbucks less, as the decrease in transactions are showing that. Coming to the income statement for Starbucks, we can see where a lot of these problems are lying. So we already know that revenues are being hurt because of lower transactions, but when you look at the expenses here, you're seeing some interesting things. Store operating expenses are up 12% year over year. Depreciation and amortization up 12%. And then they have this restructuring charge. All of that has contributed to a staggering 45% decline in operating income year over year. And that has cut the operating margin almost in half. It's now at 6.86%, down from just over 12% 1 year ago. And you see that reflected down here. And the store operating expenses as a percent of revenues, as specifically company operated store revenues, it's at 57.3%, which is up from 52.8% a year ago. But this is where the strategy comes in that I mentioned earlier, the back to Starbucks strategy. The new CEO is trying to rebrand, essentially, or really go back to their old brand of being that third place. And a part of that is going to be restructuring existing stores to be more comfortable. So a person actually wants to go in and actually sit down and have some coffee and enjoy their time there. And another part of that is they've really increased the staffing at these stores. Anecdotally, when I have gone to a Starbucks in the last year, maybe a couple years, it feels like I've been waiting longer and longer for my drink to be prepared. Sometimes there's just one person preparing drinks and there's a dozen people standing around waiting. And they also have to do all these mobile orders and then the drive-thru on top of that. It's certainly fair to say they've been understaffed. So part of this plan is to actually up the staff. That's going to increase your labor costs and thereby reduce your margins. Now, in theory, this should improve efficiency over time and get those margins back up once things start to turn around. So we'll see what happens here. But the CEO mentioned that they've increased staffing at over 3,000 stores. And they're piloting a new store prioritization algorithm designed to improve the efficiency of handling mobile orders. So if mobile orders come in at 1, 2, 3, and 4, this algorithm supposedly is going to figure out which is the highest priority, make that first. So maybe 4 gets made, then 2, then 1, then 3. But they're also spending on making the experience better. They're reintroducing these condiment bars, ceramic mugs. They're also doing some other interesting things. They removed this non-dairy surcharge for drinks, so syrup pumps, for example. They're not upcharging that anymore, as well as providing free refills for black coffee again. That, of course, is also going to hit margins. But the idea here is to increase those transactions, to keep the customers in the store longer. And if you're in that store longer, ultimately, you will spend more money. Another thing I want to note here is they had an increase in their store count of just 3%, at least in North America. But on the earnings call, the CEO mentioned that they plan on doubling the US store count over the next few years. They didn't give a specific time frame, but that's going to create another round of increased capital expenditures, meaning the decrease in free cash flow. Now, normally I think capital expenditures are a very good thing, investing for the future. In this case, however, I believe it will be a good thing if we see results of this back to Starbucks strategy starting to show itself in the earnings over the next few quarters. If we're not getting results, opening more stores is not going to help Starbucks long term. Another thing that they mentioned is reducing the items on the menu by about 30%. And that is actually one thing that I think is going to help a lot in efficiency. There are so many options there. They have all these baristas making all these different concoctions, and it's creating chaos. Simplify the menu. Go back to what made you great, and the people will return. Now, these depressed margins, lower net income, and ultimately lower net cash provided by operating activities, which really is driven by lower net income to begin with. It's starting to show itself in the free cash flow. Through 2 quarters of their fiscal year 2025, Starbucks has $1.28 billion in capital expenditures. So that means year to date, they only have $1 billion in free cash flow. This quarter, they had negative $297 million in free cash flow, which is yet another decrease year over year. Their free cash flow margin on a trailing 12 basis has sunk to 7.6%. Pre-COVID, they were regularly above 10% free cash flow margin. And you can see the financial effects that this pivot to drive-through and mobile orders has had in the last few years for Starbucks. My trailing 12 numbers aren't updated with the most recent earnings. However, you can still see a decline in the earnings per share since 2021. Revenues have flattened and free cash flow has just really fallen off the cliff here. They're not compounding anymore. And on top of all that, you can see that that dividend, that growth in their dividend has slowed to a crawl. Starbucks used to be a powerhouse. Pivoting away from their core, what made them great, has really sent this business downwards. And where that really shows up is in the margins. The COVID year notwithstanding, every restaurant business was hurt here, but just the decline in margins since they really started focusing on these mobile orders and drive-thrus. Both gross margin and operating margin, and then the free cash flow margin has never recovered to pre-COVID levels. And of course the ROIC and ROCE declining, never recovered to pre-COVID levels. It's still good, by the way. 21% for ROIC and 26% for ROCE. But right now we're not seeing evidence of this turnaround having an immediate impact. That doesn't mean it won't have an impact. We still need to give a few more quarters here for the CEO to turn it around. But I would expect more downward pressure on their share price the rest of 2025 because the margins aren't going to get starkly better. They have to spend more on this restructuring, on this staffing to get back up to an operational efficiency they had pre-COVID. And if we know anything about Wall Street, they're impatient. They want to see results right away. So what does their share price look like going forward? So these are the projections I'm using on the revenue and then on the margins. Starbucks segments their revenue by beverage, food, and other. On a 5-year historical basis, their CAGR in beverage is at 6.57% growth for beverage, 9.25% growth on food, and 3.83% on other. Other, by the way, is Starbucks packaged goods you can buy, things you can buy in the store that aren't directly from the counter, Starbucks merch, things like that. But going forward, on a base case, I'm projecting beverage growth to be at 5.24% over the next 10 years, 6.64% for food, and 4.2% for other. On a bull case, meaning they get this thing turned around, they get people back in the stores, they start increasing comp store sales. Perhaps they even reduce prices to increase that demand, to stimulate more transactions. I have beverage growing 7.1%, food at 8.1%, and other at 5.2%. So ultimately, you can see my bear base and bull case for total revenue here, 4%. Things keep going the way they're going. It's not going to be good for Starbucks. 5.3% for the base case and 6.9% for the bull case. So my bull case revenue growth is slightly above what their past 5 years have been. But here's the thing, this is a business that's very saturated. They're not a high growth company anymore. If you look at the margins here, the trailing 12 margin is at 11.9%. Bear case, I have that margin growing to 15, 16 for the base, and 18 for the bull. And ultimately for free cash flow, my bull case free cash flow margin is assuming they get back to pre-COVID levels of free cash flow. On the base case at 10.5% and 9% free cash flow margin on the bear case. You can see 4% growth on the bear case for free cash flow over the next 10 years, up to 11% on the bull case. So keep these estimates in mind here as we look at what their valuation is. So Starbucks closed at $84.85 right before earnings. The market's not open yet, but I expect this share price to fall quite a bit today. And it's going to bring that PE down right along with it. So right now, before market opens, we have a PE of 30.7 and a forward PE of 39.4. Already that PE is below their 5 and 10 year average, but that forward PE is pretty high. Now these will come down as soon as the market opens, but Starbucks is still expensive. I believe the market still believes that Brian Niccol can turn this around. He did great things at Chipotle, but given the results for this quarter, and if their Q3 doesn't show stark improvement, things could look dour for Starbucks. My DCF on the bear case is at $52.03, $67.04 for the base, and $100.14 for the bull. The dividend, $61.36 for the bear, $67.12 for the base, and $99.57 for the bull. Amazingly, their DCF and dividend discount are very well aligned. I'm projecting about 7% growth for the dividend on the base case and 8% dividend growth on the bull case. The exit multiple is at $84.39. My comps are McDonald's, Chipotle, Yum Brands, and Darden Restaurants. So we can see based on these valuation averages here, on the bull case at least, that's a $96.06 average, meaning there's some upside here. Even more upside once that price comes down today. But without any margin of safety, we have a buy price of $75.33 with a forward PE of 35. At least based on pre-market movement, it's gonna come down to around this price. But we want a margin of safety. So at a 20% margin of safety, maybe even a 30% margin of safety, depending on how much you believe in Starbucks going forward, that's a buy price of $60.26. And it very well could hit this if results do not get better in Q3. And the fact is, turnarounds are difficult. It takes time for these changes to not just be implemented, but to be executed on, to see these results show up in the bottom line. I do think Starbucks is doing some good things and going back to the Starbucks strategy here. I actually called for a lot of those things in my deep dive I did on Starbucks a little over a year ago, before the CEO was hired. Specifically, becoming that third place again and trimming the menu. But they're going to have to rebuild some of that trust that they've lost with customers due to price increases. Free refills is a good start. Not upcharging for non-dairy add-ins, another good start. Will they decrease prices though? We'll see. That will certainly drive demand upwards. I believe the strategy is sound for Starbucks, but what I'm waiting to see is execution. And until we see that show up in the bottom line, which, like I said, it's going to take a couple quarters, I would avoid Starbucks. I'd actually expect another bad quarter or two, and we could see that price come down quite a bit. But when those margins start improving, when that revenue growth starts increasing past 3-4%, when comp sales are actually going up, Starbucks is going to be a juggernaut. But for me, turnarounds aren't a thing. I don't like investing in turnarounds, but if it does turn around, this is a potential opportunity. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.